Ladies and gentlemen, if I can ask you to take your seats, and we're going to try to reconvene. The excitement of fact and analysis and pleasant academic debate is in the air. It is, of course, a refreshing change to much in the Twitterverse. I hope everyone is enjoying it. Few days till the Super Bowl, and we can start talking about the implication of Patriots for international trade. If everyone could please take their seats, I'll stop filling time and we can start giving you more of the substance you came for. Okay, I'll take the lull in the conversation. I'm Adam Posen, president of the Peterson Institute, for those of you just tuning in, and we are at the midpoint or the start of the second third of our conference on the border tax and corporate tax reforms. We've just finished a discussion of differing views on the overview of the impact and what is worth paying for in the border tax adjustment, and the three speakers, myself included, shared that framework. The question is, what is the right way? What is the assessment of costs and benefits? What we're going to turn to now is another panel fully staffed, as it turns out, by Peterson Institute fellows, talking about various specific aspects of how to think about the border adjustment tax or the DBCFT itself. And again, as we've said throughout the morning, it's not details matter in some way to just say, oh, these are trivial things and we can confuse matters. Details matter because it matters to the economic incentives, to the transparency, as someone mentioned, to the effectiveness, to the efficiency. It's complicated, and we're here to try to make sense of it. Our panel is going to have 4 speakers, all distinguished colleagues of mine. We'll begin with Caroline Freund, who's been a senior fellow here. My first hire as a senior fellow here since May 2013. She previously was chief economist for the Middle East and North Africa at the World Bank, and also in the research department there, and previous hire to that as a senior economist at the IMF and an economist at the Federal Reserve Board. Most of you know Caroline as well from her fabulous book about emerging market millionaires and global competition, and we're going to be featuring some new work she's done on global competition in a week's time at a conference on China and state-owned enterprises. But Caroline also, of course, has been a very active voice in all the public trade debates of the last year. And some of you may have seen her holding a football explaining what a value-added tax means in one of our Peterson Institute videos. She's going to take us through how this proposal is or is not a VAT. My colleague Joseph Gagnon will be the second speaker. As many of you know, Joe is, along with Fred Bergston, one of our leading advocates for standing up to currency manipulation, and has done yeoman academic empirical work, both on his own and with colleagues at the IMF, on the impact of currency interventions. He's also written on academic topics and exchange rates for many years. Previously was an associate director at the Federal Reserve Board. I want to make sure I get the title right. I know his reality was he helped design the first round of QE, advising the FOMC. He's been a good friend and colleague for a very long time. And he is, as was previewed by Chad, has done some efforts to try to put empirical background on previous instances of VAT increases and how that affects exchange rates, and he'll take us through his work on that. Our third speaker is another new hire, although a longtime friend and collaborator, Sherman Robinson. Oh, good Lord. Sherman Robinson. Sherman, of course, is a noted practitioner and developer of computable general equilibrium models, which means he's the trade guy who rigorously tries to figure out what really happens when you change trade policy. He's had a distinguished academic career, including teaching at Sussex in the UK, and a long distinguished affiliation with IFPRI, the International Food Policy Research Institute. He previously taught at Berkeley, been in the research department of the World Bank and at LSE in Princeton, and he has now joined us as a non-resident senior fellow. He played a key role with Gary Huffbauer and Marcus Noland in our studies released in September, looking at the impact of the presidential candidate's proposed trade policies. And we're very fortunate to have Sherman now more closely affiliated with the Institute and contributing his expertise. He will take a different tack than Caroline on looking at how this compares to a VAT, this proposal, and the impact on the economy. And then finally, Chad Bown, who, as I mentioned, I'm grateful to, is a lead coordinator for this conference. Chad has been a star of stage and screen since arriving at the Peterson Institute a little less than a year ago. I think many of you have read, and if you haven't, I would encourage you to read his very pithy summary of what trade agreements are for. But he's also, like Gary Huffbauer, someone who straddles intricacies of international trade law and actual empirical trade economics, and so is a huge addition to our team. He has previous service, as did Sherman, as a senior staff economist at the Council of Economic Advisors. So let me now turn over to Caroline. Thank you very much, all of you, for your contributions to this discussion.
So I think one thing we can all agree on is that we want a tax system that promotes growth, that doesn't discourage saving and investment. We also want a tax system that's equitable. And other countries have done this with a VAT and a low corporate tax rate. I think that's something that most economists would agree is a good way to go. Instead, what we have is something that kind of combines this low corporate tax rate and VAT all into one thing and calls it a cash flow tax and then adjusts it at the border. What I'm going to focus on today is just the border adjustment part. So the reason to do this, of course, is if flows are destination-based, or if the tax base is destination-based, it can't move. So you want to tax something that can't move because that's going to be a more effective way of raising revenues. But somehow this tax system has all gotten confused with trade policy. And in part, this started, or it's gone on for many years, this view, and it's certainly prevalent among people in the Trump administration, that VAT rates are actually a tariff. So just looking at this comment during the September debate, when we sell to Mexico, there's a tariff. When they sell into us, there isn't one. That's not fair. And he's talking actually about a VAT and calling that a tariff. So what I want to do in my presentation is convince you of four things. First, that the VAT offset at the border is actually not a tariff, and it doesn't look anything like a tariff. That the border adjustment in the cash flow tax is not a VAT, and there are some important differences that we have to think about. I do believe the real exchange rate is going to adjust, and Joe and I have done extensive work on this, which he's going to present, looking at individual cases of implementing a VAT, changes in VAT revenues over time and how that affects things. And what we find is that the real exchange rate does adjust. I think there's one confusion in this whole debate, which is there are two ways of adjusting a real exchange rate. You can do it with the nominal exchange rate, or you can do it with prices, or prices and wages. And what we actually find is a lot of it comes through prices and wages. And I think that's what's going to make this version of a VAT, which I'm just going to call for short a BAT, but I mean the border adjusted cash flow tax. What's going to make this thing look really messy is if the adjustment is going to come through prices, how long it's going to take and such, is going to lead to some discrimination. Now, it's not necessarily a bad thing because you're subsidizing wages, and maybe we like that. It's a fiscal devaluation, effectively. So you're actually encouraging exports and subsidizing domestic labor. Maybe there's something to like in that, but there's also a big disruption, and there are going to be some sectors negatively affected. So since I seem to really be stuck on the Super Bowl, even though I'm not a football fan. I did decide to use a football for this presentation as well, because it is a product that some companies, Wilson in particular, produces in this country. Some are imported from abroad, and some are probably produced with imported materials. So we can think about this as, how is this product going to be affected under a VAT, under a BAT, and how are producers going to be affected differently? So let's just remember for a minute what a VAT is. A VAT turns the producer into the tax collector. So when the producer of the pigskin here sells it to the football producer and maybe sells it for $5, if the VAT rate is 20%, he collects $1, gives it to the tax office. When the football seller sells the football, he collects the $2 in VAT, passes that, but also gets a refund for the VAT that was paid when he purchased the material. So we end up with the total VAT being raised that way through the production side, and the BAT's going to work similarly. So the VAT ends up being just a tax on final consumption, and the reason for all this complication is you don't want taxes to cascade. So you wouldn't want the pigskin to be taxed once when it was sold to the football and then taxed again when the football was sold. So the whole reason to do something like a VAT or just a final goods sales tax is to avoid cascading, but it's not discriminatory. So in the case of Mexico, everything in Mexico gets taxed at 16%. Yeah, there are sectors that are left out, and that creates some complications, but the way an idealized VAT works is everything gets taxed at that rate, so imports get taxed at that rate as well. Exports go somewhere else and get taxed in the location where they're consumed. Very straightforward. It's not a tariff. There's no evidence whatsoever that VAT rates, this is just VAT rates from the OECD on the horizontal axis, and the trade balance as a share of GDP on the vertical axis. There's no evidence that VAT rates are correlated with the trade balance, and this is just a simple cross-section taking all the data available over the last 20 years, and you can see that even within countries at one VAT rate, their trade balances move around and such. And again, the work with Joe is going to really convince this, even looking within countries over time in any direction. The correlation is pretty much centered around 0. So now let's go back to the football and think about what the BAT's going to do. So if the producer's domestic, the pigskin seller is going to sell the leather, take out the labor costs, pay the VAT only, or the BAT, sorry, only on the remaining cash flow. Then the football seller is going to sell it, take out the leather costs, but the tax has already been paid on the profit part of that, so it's still getting paid. Take out its labor cost. Tax base is now $3, pay its tax. So we're going to end up with a total tax of $1, again collected not at the border, but like the corporate income tax. But what happens if the intermediates are imported? Now this is where this thing gets really different. If the intermediates are imported, it can't be deducted. So the $5 in leather is going to pay the tax on that full $5. So this is why companies that use a lot of imported inputs are concerned, because now this football producer, who looked very similar to the other one, is going to face a higher tax rate because his tax base is everything except labor. So the tax is going to be $1.60 in this simple case. So this leads me to sort of a table of how the tax rates are going to vary across firms and across industries, but even across, as I said, across firms even within industries, because it's going to depend on how you produce. So in this example I gave where the labor share overall of the football was half, it was pretty high, The domestic producer is going to pay the lowest tax rate. A producer that is in a global supply chain importing the pigskin is going to pay an intermediate rate, and the fully imported football is going to pay a higher rate. So it's going to vary both by how international you are, but also by your labor share. If I brought that labor share down to 0, since that's what's excluded, the tax rate would actually be uniform across. So it's going to vary on 2 levels. One, how much of the product is imported, what %, and the other, what the labor share is. So if we look at those 2 elements and where the industries are on them, so in this scatter plot, and the size of the bubbles is the size of overall trade, exports plus imports in the sector, and up and down is the net trade balance relative to total trade in the sector. So basically, the up guys, there's more exports than imports. Remember, exports are tax-free. So these guys are facing a lower tax rate, going down, facing a higher tax rate. Also, labor share is deducted. So going out where labor share gets higher, you're facing a lower tax rate. Going in, you're facing a higher tax rate because you don't have a lot of direct labor costs. And these are direct labor costs, not the labor embodied in your intermediates. So you can kind of see why motor vehicles is upset about this tax. They're being hit on both. It's a relatively low labor cost sector, and it's also a net importing sector. Aerospace, on the other hand, that is lined up behind this reform, is doing pretty well on both accounts. But the industries actually, in this portion, are going to be the industries where actually that discriminatory effect is the strongest, because the labor share is high and it's excluded from domestic production, but it's not excluded from the imports, and they have more imports than exports. So these are kind of the industries where the discrimination between foreign and domestic is going to be strongest. And it's interesting because there's some of the typical labor-intensive stuff. Obviously, we import a lot of that, like apparel, metals, and furniture. But it also turns out to be some of the high-value stuff where we have a reasonable labor share, in part because the workers are expensive in those sectors. But of course, it all boils down to, again, the real exchange rate. If the real exchange rate adjusts, we actually don't have to worry about that. And that's the next thing I'm going to convince you of, because nothing real will be affected. And we expect the real exchange rate to adjust because right now, from a firm's perspective, exports aren't taxed. So the firms want to send more products abroad. So that's going to push supply abroad, increase demand for dollars to buy those goods. Imports are taxed, decrease demand for imports, decrease demand for dollars. In addition, both of these are going to push on prices. Domestic prices, because more goods are flowing out and less imports are coming in, so prices are going to be bid up. So these forces are going to appreciate the real exchange rate, which is actually going to offset. And you can go through the savings and investment argument, and I would tend to take Doug's view. If you're just looking at the border adjustment, that argument works. If you're also looking at the fuller tax reform, then of course it doesn't. But for all these reasons, we believe it's going to happen. But where I really disagree with Doug is that it's going to happen fast. We absolutely do not know that. The work Joe and I have done looking at how much time it takes doesn't suggest that it's just an immediate thing. It also suggests that a big share of it is going to come via prices, something we haven't talked about. So just to convince you, though, that if the exchange rate adjustment does happen, our football guy's okay, if we look at the domestic producer and go down and just figure out that producer's profit, and we do the same for the integrated producer, if we have an appreciation of 25% or a depreciation of the other currency by 20%, then the offset that I have to pay 20% more in taxes is exactly met by the fact that my input got 20% cheaper, so my total after-tax profit ends up the same. So the exchange rate adjustment, if it happens, works. There's no reason we have to believe that it has to happen through the nominal exchange rate. I could raise prices and wages on the left-hand side and get the exact same outcome. And in fact, that's often what we see happening. So when we compare a VAT to a BAT, I think the real difference is and I think Gary brought it up in his presentation, is the fact that there's this wage deduction. But it makes for a more complicated exchange rate adjustment in my mind, because what we see in some of these VAT episodes is you do the VAT or you raise the VAT and prices go up by the exact amount and boom, you're done. But that can't happen here because there's so many different prices across different industries. There's even a name for this price going up, and there's a huge literature on it that does seem to show it's a one-for-one thing. It's called full forward shifting. So I think the BAT is uncharted territory, and there's a lot of reason to expect that it's not going to come through the nominal exchange rate that we've already discussed. I think Adam made this point that, trader flows are 300 times trade flows, and not even comparing at the same time consistent, 1 day to 1 month. You also have some fixed exchange rates out there. A lot of commodities and such are priced in dollars, et cetera. So you end up with this situation where I think it's more likely to actually come through prices. That's going to have all sorts of other kinds of effects. We don't even know if the Fed's going to accommodate this thing. So how long is it going to take? I don't know. So I think there's lots of complications about the exchange rate adjustment that will happen with a BAT that aren't necessarily there with a VAT. And this is a perfect time to turn to Joe, who's going to talk about what we actually found in the case studies. Thank you.
Okay, thank you. Well, as Adam said and Caroline said and others said, the full tax plan that's being considered for the United States is really unprecedented, and we can't actually look around the world to find an exact example to tell us what will happen. But it can be split up into pieces, and effectively, you can talk about one of the pieces as being a consumption tax that's adjusted at the border. And we do see these around the world. In fact, the U.S. is almost unique among advanced economies in doing very little of this. And so we have a lot of evidence of what that does. But as I want to stress again for one last time before I launch into my results with Caroline, that we are looking at one piece of the whole picture, but an important piece. Okay, so this is work I'm doing with Caroline, and we hope to wrap up final revisions later this week based on what we hear from you all, and look for it on our website hopefully soon. Don't know exactly when, but probably later this month. You'll see more details. Okay, so let's see. So just to quickly hit the bottom line here, what we find when we look at border-adjusted consumption taxes around the world is that the data do broadly support the view that these consumption taxes are fully reflected into real exchange rates. And what do I mean by the real exchange rate? I mean the ratio of overall consumer prices in one country relative to other countries, correcting by the exchange rate that, of course, makes them into a common, that can then make them comparable in a common currency. So that's what economists call the real exchange rate. And the adjustment can come through consumer prices overall, or it can come through the nominal exchange rate, or some of both. And I think, as Caroline said, there's sort of evidence that it seems like more of it's coming through prices in our data, but I wouldn't say it's entirely that. What we find is that the estimates are not precise. There's a range, and real exchange rates are very noisy variables. They are very volatile, much more volatile. They swing by large amounts, much more than tax rates do. And I think this reflects the point that Adam made, which is that there are a lot of other trades going on and transactions going on that move exchange rates besides these pure trade transactions, and that causes exchange rates to just be much more volatile. So it's hard to get precise estimates. Also, CPIs themselves have some measurement issues. There are differences in how they're measured across country and whether they actually are measured the way you'd want them. And finally, we have annual data, and sort of tax changes happen at different times in the year. It's kind of hard to precisely get the timing of these effects. But I would say that, so basically we find effectively full effects of border-adjusted consumption taxes on the real exchange rate and effectively zero on trade balances. And these two conclusions actually go together. It's not always true when you look at the data that they make a consistent outcome, but in this case, these two are consistent. If you get a full offset in price from this tax, you would expect no trade effect, and that's what we see. If you didn't get a full offset in price, you would expect some trade effect. So the fact that these two results separately hold is a nice feature of the data. If we didn't have it, we'd say something funny is going on because it wouldn't be consistent. Okay. Taxes on consumer goods and services are common around the world, much more common than in the US. Germany is pretty much a typical country. Germany in 2014 had total revenues of just over €1 trillion. About a third of that was income taxes. A little more than a third of that is payroll, Social Security tax. A little less than a third of that is goods and services taxes. It's about 296 billion euros, of which about 2/3 is value-added tax that you've heard a lot about. But another chunk of it is other taxes on consumer goods and services, such as gasoline tax and alcohol and tobacco taxes that are important. And theoretically, you would want to include all of these consumption taxes. They're all border adjusted in the sense that consumers in Germany pay these taxes whether or not the good is imported. But when Germany exports these goods and services, those taxes are not paid because consumers in other countries are meant to pay them. So we focus on the red line, which is one level up from the VAT, which is all consumption, border-adjusted consumption taxes in Germany. And then we calculate the effective rate of consumption tax by dividing those taxes by total consumption in Germany, which is about €1.5 trillion, so that the effective consumption tax rate in Germany is 20%. Okay? And that's what, when I refer to the consumption tax rate, that is what I'll be referring to. Okay. So we have a three-pronged approach to seeing what these things do. And the first part of our analysis is to look at event studies. We could find 10 cases of countries that introduced a value-added tax at some point in time when we had lots of data, both before and after, that we could look at what happened. And so we're going to sort of average those 10 episodes that happened at different times in different countries, but average them and see what happened around the time that country imposed that VAT. Now, what happens? It could be that the VAT is offsetting other consumption taxes, and there is certainly an element of that. Sometimes excise taxes are reduced when the VAT, or they're replaced by the VAT, or a sales tax is replaced by that. In that case, you would not expect much to happen because they're both border-adjusted consumption taxes. But to some extent, we're replacing other taxes, or maybe we're increasing total taxes, and in that case, maybe you would see something. Now, often these are part of other reforms which have other effects, and so the drawback of the event study method is that this could be part of a fiscal consolidation, which for other reasons should have effects on the exchange rate and the trade balance, and so that's what makes this problematic, but it's worth taking a look. So here's what we have for the 10 introductions of value-added tax. So the first panel shows the actual tax rate, and as you can see, the red vertical line at 0 is the year in which the VAT is introduced. And as you can see, generally speaking, this did lead to an increase in consumption taxation in these countries of about 1.5%. Not a huge change, but notable, nevertheless, at that point. And so what happened to inflation? Well, the middle panel shows that inflation often was high in some of these cases, and if anything, it was falling. So it's not clear what's going on. But it turned out that there were 3 cases that had very high inflation, and part of the VAT was actually part of a broad stabilization program. If you exclude those 3 countries, then you get the panel on the right. And then what you see is there is some upward effect on inflation when the VAT is raised. But again, even in these countries, that quickly falls because it's often part of a stabilization. So that's sort of a messy experiment, a slight evidence of higher prices. So what about the real exchange rate itself, which includes both inflation and exchange rates? And that's sort of the more real, relevant thing that matters. Well, the first panel shows that the bilateral real exchange rate against the U.S. Does rise at that time quite strongly. The right panel shows that the real effective exchange rate that's weighted by trade partners also goes up, although there's a bit of a lag of a couple years, which it's a little bit of a puzzle, but definitely there seems to be a strong effect later on. If anything, these effects are almost a little too big. And again, oftentimes these were part of reforms that the market liked, and to some extent the exchange rate may have moved too much. And we'll see later on some evidence for that. But yeah, certainly the evidence suggests that the real exchange rate does rise, if anything, surprisingly more than you'd think. Finally, on the trade balance, the trade balances were rising going into these VATs. We're not quite sure why. That could be that this is part of a fiscal consolidation, fiscal tightening going on in these countries, which would be expected on its own to raise the trade balance. So after the VAT is introduced, you don't see much strong evidence of further increases, but it's a little unclear. Depends on how far you want to go. I guess I'd call this somewhat inconclusive, especially when you think about the other things going on. So some regression analysis. I'm not going to walk you through these equations, but we look at the long-run effect. So we're basically, the variable of interest, I don't know if this is going to work. Oops. Is that, if you could see it. It's goods and services tax revenue as a share of consumption, so that's our tax rate. And we're trying to relate the real exchange rate to that. So this coefficient alpha, is it 1? Theory says it should be 1. And then the trade balance as a share of GDP, relate that to the tax rate, is it 0? And that's what we basically find. We focus on the long run. So we have 16 regressions focused on the long run effect of the consumption tax rate on the real exchange rate. 8 use OECD data, 8 World Bank data, 8 have the bilateral rate with a dollar, 8 have a multilateral rate, 8 have a whole bunch of macroeconomic control variables such as fiscal balance and government revenue, et cetera. 8 don't. 8 have effects that allow for things going on in each year. 8 don't. There's 35 advanced economies and about 35 years of data, but not every country has the full set of data. What do we find? Well, for the consumption tax rate effect on the real exchange rate, these are the 16 coefficient estimates we get. They cluster around 1. The average value is 0.9. 9 of the 16 coefficients are significantly greater than 0. They're in red. One of the coefficients is in blue, and it's significantly less than 1, and the other 7 are gray, and they're not significantly different from either 0 or 1. But the average value is 0.9. And if you look at the further details of the results, half of that comes through immediately. And we think that's probably a price effect that happens immediately. And then the other half comes over the next 2 or 3 years. So that's the real exchange rate result. And then we do the same thing on the trade balance, same 16 regressions. Basically everything's the same except 8 now are on the current account balance, which is the broadest measure of trade, and then 8 are on the goods and services trade balance, which is a slightly narrower measure of trade. But otherwise, we have the same split of controls, no controls, et cetera. What do we get? Well, we get coefficients, 16 coefficients clustered around 0. 2 of them are significantly greater than 0. They're red. 2 are significantly less than 0. They're in blue. The average value is 0. And again, I would remind you that this result is consistent with the previous result on the exchange rate. Now, the two go together in theory, and it's nice that in the data, although they didn't need to happen this way, the data seem to say they do go together. So there is adjustment of prices such that exports and imports should not be disadvantaged or changed. It's kind of unusual in economics when the data actually support what the theories say. So I think we were a little surprised. Frankly, we were surprised at how it popped out. I actually wasn't sure what to expect, but it was neater than I thought. Finally, there's really only one case that really looks like what you'd want to look at, which is New Zealand in 1986, which switched from, had a major set of reforms, but the biggest single piece of it was to move from income taxation towards consumption taxation in a VAT that was border adjustable. And they have a very clean VAT. And this reform was implemented in October of 1986, and so the red vertical line at 0 is 1986. But because actually the reform was done very late that year, most of the action was in 1987, and that's why you see the green line is the real effective exchange rate, jumps up strongly when the tax really hit in 1987, and it continues up a bit before tailing off. If anything, it appreciated a bit too much. The VAT was 10%, but it did replace some other taxes, so the net change in the consumption tax rate wasn't a full 10%. But the exchange rate went up more than 10%. Basically, the markets loved the New Zealand package of reforms, and they pushed the New Zealand dollar way up, and then they sort of overdid it, and it gave back some of those gains later. But basically, this gives you a sense of what's going on. The effect on inflation is the red line. Inflation was high, but it was starting to come down, but it bopped up a little bit in that year before falling. So a lot of this probably did come through prices, we think. As far as the current account balance, it was negative. It was slowly rising, continued to rise. This was part of a big reform, and a big part of this reform was fiscal consolidation. So you would expect some increase in the current account, but not a huge amount. And I guess that that's all we have to say. Basically, although we can't be as precise as we might like, for this particular consumption, border-adjusted consumption taxes around the world, seems to support the theory.
Okay. Well, we've now had a lot of detail on the VAT. We've, see if I can get this. And we cleared the statement that they're different, the VAT and the wonderful acronym that Adam seems to have trouble pronouncing. They are similar. They both affect price of domestic and produced goods in the domestic market, what we in our modeling world call PD. They both require a border adjustment tax to be trade neutral. That's absolutely similar across the both of them. The VAT's very well understood. We've been studying it for a long time. We have no examples of the destination-based cash flow tax, so we really can't rely on any historical experience. And I guess like any good engineer type, which I describe myself as, if I can't study it empirically, I simulate it. And that's in fact what we have done here. There is a long history of economic simulation models of the class I'm associated with, computable general equilibrium models, looking at tax systems, including VATs and various corporate income taxes. And we have been working on one for the US, which we are in very early stages of implementing, that captures this tax system. So, a couple of important points about that. First, I'm going to focus today on just the previous question. What happens, we understand if the VAT works perfectly, it's wonderful. We've heard that in some detail. What happens if it doesn't work perfectly? Where does it crash around in the system? That's what I'm going to look at the simulation, and the exchange rate is clearly one area where that's important. We've heard about the exchange rate. I'm actually quite sympathetic to the view that the exchange rate in the VAT systems it works just fine. I'm less convinced in the VAT systems for reasons that we've also been hearing today. The problem here is, as Adam made very clear, the exchange rate is a signal on global asset markets and gets driven by that. But we're interested in it because it affects relative prices in the domestic economy. That's where if it's going to work to achieve trade neutrality, that's where it's going to work. Note also, and I'm also very sympathetic to Douglas's argument, it is a one-time adjustment we're talking about. So we aren't really talking about a kind of destabilizing things. It is kind of a one-time adjustment. So the other big issue floating around here is what happens if the exchange rate mechanism doesn't work? I mean, something goes wrong, which I have colleagues here at PIIE fervently believe that. Well, you have a couple of options. One is, as Caroline stated, and I'll show you in a simulation in a minute, the domestic price system adjusts around it and you get back to neutrality. The other option is, well, no, the trade balance actually gets kicked because the fixed exchange rate may potentially affect the trade balance, and that has a whole bunch of effects in its own right, and it really messes up the entire equilibrating notion of the VAT. You will not get the kind of neutrality that we're looking for. So we simulate both of those options and ask sort of what-if scenarios. These are not forecasts. These are projections under very stylized shocks to try to understand what will happen if the system doesn't adjust properly as it moves along. So what if it's only partially implemented? What does that do? It is an integrated system, so you can't actually step in and say, well, actually I'm going to do this, but I won't do a VAT. That's not an option. It's, as it's been explained to you, it's kind of implicit in the signaling that comes about through it. But it still may not work in the link to the actual exchange rate that we look. So what happens if that happens? Second, what if the tariff implications, the tax adjustment that's implicit in the VAT doesn't work, that people don't view it that way? In the case of the VAT, it's very clear. Every time you buy something in Europe, you get a little slip of paper that tells you what it cost and how much the VAT was. We are faced with the VAT in an implicit tax of that sort that's supposed to fall both on imports and domestic goods, but it is implicit. Economists believe these actually have real effects, but when you actually get out there in the real world, that may not happen. So we did basically a set of simulations where we looked at that. And in the first case, 20% domestic sales tax in BAT. In the first case, we are looking for the real exchange rate effects deflating by the consumer price index, one of the standard ways of doing it. We get the exchange rate adjusts, the consumer price index is locked, everything's relative to that. The wage doesn't change, real exports and imports, these are percent deviations, so nothing is happening in exports and imports. These are the data for the US, and when we did this, it was 2011 data. Nothing happens, it works. BAT does exactly what it's supposed to, it's neutral, and we can go on and look at what it does to the corporate income tax and that sort of thing separately. Now, let's assume, though, that the exchange rate is fixed. It doesn't adjust for whatever, but it needs to adjust. Well, then in that case, you get real problems. You have real exports go up because this is, in fact, an export subsidy. I mean, that's the way it will actually work. In the end, real imports, in this case, actually go down. Real consumption falls because the trade balance vastly improves as a share of GDP. So you basically get a mercantilist solution. If you happen to believe that exports are good and imports are bad, you might like this solution. We've known for hundreds of years that that's not really a good idea. And then the last one is, well, okay, the exchange rate can't adjust. Both Caroline and the proponents of the BAT says, well, all right, the domestic price system will adjust around it. In that case, it has to be the domestic prices of goods produced and sold on the domestic market. That's the price you have to know, because that's the relative price you have to hit. We'd simulate that. In that case, the consumer price index goes up 20%. The average wage goes up just about 20%. Real wages don't change, but I think you would notice that. If we actually observe that kind of adjustment, that would be pretty serious. It does have the advantage, though, that you don't bang the nominal exchange rate around the world financial markets. So you have captured that. Then the next step is, what if we assume that the tariff doesn't work? I don't actually see this implicit tariff. It doesn't get communicated down into product markets for whatever reason. If you have that, then you end up with an equilibrium, consumer price index locked, exchange rate devalues about half of what you're looking for. And in this case, real exports go up, real imports go up. It is a classic protectionist move. But no change in total trade balance. So but it is definitely, believe me, the WTO would notice this. This is a really serious one. Assume that but this is not allowing anything to do on the trade balance. Now let's assume that, in fact, we lock the exchange rate in this version. So basically we're saying that price adjustments don't work, and we'll also fix the exchange rate. In this case, it just completely falls on exports. Exports go up 17%. The trade balance falls even more. Trade balance is what matters in this model. It's balance of trade in goods and non-factor services. It's not the current account balance, which is why the numbers are a little bit different. But it is the number that's relevant if you're looking at commodity markets. So as you can see from these kinds of scenarios, you can get all kinds of really unpleasant banging around in this system if it doesn't work. Where do I come out of this? Well, these are important. These are actually big numbers. So you really do have to worry about them. We're talking about not little marginal changes in this. If you don't have a trade balance, you get it to work properly, but you get no change in the exchange rate because you wanted to operate around it. Auerbach actually talks about what if you introduce it and you join the Euro countries. You really hit your domestic price system. You're going to see major adjustments in wages. It's just not going to work, right? If you do it with the exchange rate changing, you are going to hit 20 up to well, close to 20%. We get a little bit less because there are existing taxes in the model, sales taxes, tariffs, and trade margins that change the base on which it is applied. This is not an ideal system in that way. I'm sympathetic to actually the view that Doug gave that says, if you see that coming, I have TIIE CREF and I've got foreign stock funds, I'm going to shift them instantly on announcement into the U.S. That we will notice, because furthermore, I think you'll overshoot because I think everybody wants to get through the door first. Right? So I would actually worry about instability of introducing something like that. The incomplete scenarios, all of them mess up the trade system. All of them are violations of WTO rules. And if they notice that, which they should, you're going to get into all kinds of trouble with the trade agreements. If all of them with a fixed exchange rate are mercantilist, they are, and if you believe exports are goods and imports are bad, you'll like them. They are a very bad idea from our perspective. They all result in lower aggregate consumption in the U.S. because of the change in the trade balance towards surplus. They're all violations of trade agreements. The final one that worries me, and this is hearing the discussion today, and it's gotten me more and more concerned as I considered it. Doug Holtz-Eakin said very clearly, we don't actually put a border tax, we don't actually put the customs people at the border and actually charge an explicit tariff. It is an implicit tariff. That means that basically we have to associate some part of this tax to acting like a tariff. And this is a tax computed by the CFO of companies once at the end of the year, and we have to believe that is a signal down into markets for imports. It would also, by the way, completely not show up in any government statistics. So if you were trying to ask the question, did this work? And I want to look at tariff, I can't. It's all implicit when you do it that way. It makes me come out in this continuum of opinions at PIIE. I like the VAT. You can do this in a VAT mode. We know that. And that means, though, all the signals are explicit. They are in the price system. When you get the little sheet of paper, you'll see, when you buy a cup of coffee, you'll see exactly what this tax is. I think that's a major advantage. But on the other hand, I like the principle. And there's no reason you can't mix a VAT implementation with the kinds of things that Doug wants to do at the corporate tax level. They will not give the same answer. They are somewhat differently distorting. But I'm frankly agreeing with Gary on this. I'm willing to live with that in order to get such a system in place. Stop. We're not going to do that. How do we get out here? He did let them do it.
Okay. I'm going to wrap up this session by going into some additional detail as to what I think the potential WTO longer run implications of this are, building a bit and complementing some of the points that Gary already made in his presentation this morning. So broadly put, there's three main points that I'm going to try to get across or examine that I'll throw out there as being important. The first is, on what legal grounds might the Ryan-Brady border tax adjustment be challenged at the WTO? And I think Gary has already talked a lot about that. I will say there's additional uncertainty there. Second, if the border tax adjustment is challenged and found to be WTO illegal, what are the implications of that? So I want to kind of walk us through what that would mean in the WTO dispute settlement system based on how we've observed the WTO system to work thus far over its first 20 years. What could we expect to have happen there? And then given those two things, what are the implications? So how should we allow that potentially informed, to kind of get back to Adam's bigger question that we live in this interrelated world, how should we allow that to inform the U.S. tax reform process right now? So let me just, on the legal grounds, I'll make 3 points, and they're very quick, because this is obviously not my comparative advantage necessarily. First is to just reiterate the point that Gary made, which is the existing WTO rules and jurisprudence aren't 100% clear on this. There's a distinction between the way products are treated under VAT and sort of consumption-based system versus how income is treated, that economists would say don't necessarily make much sense, right? And so I think there is potentially a big battle there in scope for potentially WTO disputes. The second, I think even if there were really clear language and guidance from the law and the jurisprudence on this, there is this underappreciated aspect of the WTO where countries can file these things called non-violation, nullification, and impairment complaints. Meaning even if there's no explicit GATT WTO provisions that say you can't do that, you're allowed to bring disputes and potentially win them if you can show that, no, I've been discriminated against because they were creative. They came up with some way of implementing a policy that discriminated against me, violated national treatment, treated my goods differently from domestically produced goods, that the framers of these institutions couldn't have anticipated and written down ahead of time, right? So there's always that possibility there. And then third, as we've seen over the last week, there's also the political arguments that some of the politicians may be giving the evidence to trading partners for them by saying that this tax reform is designed to target and punish trade surplus countries, to fund border infrastructure projects, et cetera, that really are only going to serve to muddy the potential WTO implications of this. So I'm much more sanguine about the possibility of a WTO dispute arising from this if we don't pay attention to what the international aspects of this are, and thus that we should think through them. Okay. As a little bit of background for folks that don't spend all their time thinking about WTO and dispute settlement. I don't know why you wouldn't, but it's true. That's why we have me. There have been 500 of these types of cases that have been brought to the WTO thus far. Now, not all of them work all their way through certainly not all the way through the legal process, but there's been 500 of these. And for the United States, it's been really one of the biggest, if not the biggest actor in the system. Over 100 cases it's brought against trading partners, and it's had over 100 cases brought against it, right? So the U.S. is both the architect of the system, but it's most active engager in the system, okay? There's been a couple hundred of these disputes that have, reached the stage of having important legal decisions, panel reports, appeals, and all that stuff made. So there's a lot of jurisprudence out there. But all that being said, there's really only been 13 that have gone all the way through the process to reach the stage where it's up to the WTO to determine the retaliatory compensation that's going to be there if we can't come up to a negotiated settlement. Only 13 real examples that we can look at to help inform us as to figuring out by how much trading partners would potentially be allowed to retaliate against us if this policy, this tax reform policy, were to be ruled WTO illegal. So we've only got 13 of those. Now, of those 13, the U.S. has been heavily involved. It's been involved in 2 on the outbound side against the Europeans. These are the famous, the banana regime case in the Latin American countries where the U.S. was exporting banana services, Chiquita Dole, and beef hormones, obviously, where we retaliated against the Europeans. The WTO set the limit on what that retaliation would be. And we've also been involved in the other side. We've had cases brought against us where countries have been authorized to retaliate. Examples are the Byrd Amendment case, for example, or the FSC case, the Foreign Sales Corporation tax case as well. The sizes of these awards, and I just want to flag these for you just as a marker, the biggest one of these retaliation cases ever is $4 billion. The Europeans were authorized to retaliate against the United States in the Foreign Sales Corporation tax dispute of the early 2000s of $4 billion. That's the max. Smallest Canadian version of the beef hormones dispute with the Europeans, 11 million Canadian dollars. The most recent one is this recent U.S. or Canada-Mexico cases against the United States and country of origin labeling ruling for meat products. That was about $1 billion. But, usually these things are a couple $100 million, not big potatoes by what it is that we're talking about here, okay? So what I want you to do is to imagine a scenario now where we implement this tax, the border adjustment piece. Trading partners file a WTO dispute against us. right? It's ruled, yeah. And so let me step back here for a second and say, first of all, I agree completely with the analysis that Caroline pointed out there. This is not an import tariff, and it's not an export subsidy, right? That's not what these policies are. That being said, they can have discriminatory effects, especially we think, based on some of the evidence, that may manifest themselves in the short run before all prices in the economy are able to adjust, right, which is enough period of time for trading partners to observe this, to feel discriminated against, and to actively initiate disputes against us, right? So that's a scenario I want us to think about first, is let's suppose we implement the policy, trading partners see what happens, they decide to file a WTO dispute against us, they win the legal arguments, essentially that it's, I'll walk through different cases of if it's an import restriction, like a tariff or a quota, or if it's an export subsidy. Those are the two basic distinctions under WTO practice for these retaliation cases anyway. What then happens next? Okay, once trading partners are authorized to retaliate, how does that work? So what the WTO does is they use, on the import restriction types of disputes, what's called the trade effects formula to figure out the upper limit, the maximum amount that a trading partner is going to be permitted to retaliate against the United States. And what they do is the trade effects are essentially their lost export revenue associated with this policy, okay? Associated with, you know, the import restriction. So let's walk through what that might mean in this case. So the data, 2016 or so, U.S. imports globally are about $2.2 trillion. If we take the Ryan-Brady border adjustment tax as about 20%, and we say, well, not all of that is trade restricting, but there is this discrimination that might be enhanced, especially with the differentiation that Caroline pointed out that arises across because of labor share, the wage deduction, essentially. So let's suppose the labor share across the U.S. economy averages out to about 50%. I'm just using rough numbers here so we can see magnitudes. So this basically means this thing is equivalent to like a 10% tariff, okay? 10% tariff, you need to think about, well, what's the trade elasticity of a tariff? Suppose it's 1, right? So a 1% tariff leads to a 1% reduction in trade. Well, starting from $2.2 trillion then, a 10% equivalent import tax or trade restriction is going to eliminate essentially $220 billion worth of trading partners' exports into the United States. $220 billion, okay? That's the amount by which, if the WTO just dusted off the shelf its formula for how it's done retaliation in all these earlier disputes, the country of origin labeling dispute, beef hormones, bananas, they dust off that formula, right, with a 10% discriminatory aspect of this tax, $220 billion, right? Now, obviously, that is just orders of magnitude above anything the WTO has ever dealt with. The biggest retaliation ever authorized to date was $4 billion in the FSC case. This is $220 billion, okay? So U.S. exports at the moment are about 1.5 trillion, right? So these are numbers that are just huge. Okay, but that's only half of it, right? Now, they might also say it's not only an import restrictor, it's also working as an export subsidy, right? So what happens there? Well, let's just apply the same logic on the other side. An export subsidy of 20%, but it's only for the 50% labor share that's getting the subsidy, fine. So it's not a full 20%. It's only a 10%. Now, in these export subsidy disputes, they don't look at trade effects. They actually look at a bigger calculation, which is to say we're going to actually allow trading partners to restrict trade equal to the size of the given subsidy payment that you're making here. So just working through the math, again, assuming a 1 trade elasticity, you come up with a number that's about $150 billion for retaliation on the export side, right? So you can imagine then, okay, well, let's put the two of those things together. Trading partners are authorized to now retaliate $220 billion, 65. I just can't even do the math. It's so big, right? Is essentially what the numbers are, right? Okay, so you see where we're going with this, right? This would be completely out of hand and unprecedented for the WTO to have to handle. Now you might say, Chad, your numbers are too big, right? So, okay, the labor share is smaller, the elasticity is smaller, fine. So cut them in half, right? You're still talking about levels of retaliation that are unbelievably large relative to what the WTO has handled to date. Well, then you might say, but no country is going to bring a case like this against the United States, right? We're big, we're tough, nobody would do this to us. Maybe, but there are lots of examples out there of disputes where countries have formed coalitions and brought singular cases against one trading partner. We've done this with other countries on the export side. So in the bananas case that we brought, it was with a bunch of Latin American countries against the Europeans. We've had it happen to us on the import side. The Bush steel safeguards is a big example. 9 other countries brought the case along with the Europeans. The Byrd Amendment case, the recent cases we've had against China have been brought alongside Japan, Europe, Mexico, et cetera. So this is not unheard of, right, that a group of countries wouldn't get together. But even if you didn't believe that, and you just say, well, would it be worthwhile for any one country to do this? So let me break it out by country. And again, this is just on the import side, right? Taking these large numbers, 220 billion. If you follow this logic of this math, a country like China could be authorized to retaliate by $46 billion. And this isn't even including the export subsidy component. This is just treating the trade effects as the formula. Mexico could be authorized to retaliate by 30 billion. The Europeans by 40. So the point of this is that these numbers are extraordinarily large. And I'm obviously very concerned if we think we can go down a path that's not worried about the international implications of this and the potential discriminatory implications of this. Okay, so I want to wrap up with one last statement here. Countries would never bring a dispute because they are afraid President Trump would pull the U.S. out of the WTO. So let me talk about why I think this statement is wrong. And there's a couple of different reasons. I think the first, and I am not disagreeing with Gary, that these disputes do take a lot of time to work their way through the process. But that's a reason alone why trading partners might actually bring a dispute, because they might recognize that it's possible. We have elections every 4 years in the United States, that in 2021, there's a different president there that is not necessarily going to blow up the system, right? And pull the United States out in the event of a negative WTO ruling, right? So that's one. On the other hand, though, the big concern is that if you are part of the group right now that is writing this legislation and designing this legislation and thinking about it, politics change, right? If you're trying to get the tax reform right now and under this type of new system, this is what you want, there could also be a completely different Congress in place 4 years from now, right? That should be reflected as well. The last important point I want to make is sometimes you hear these arguments, well, we can try it. We'll worry about the WTO consistency. It takes 2 or 3 years, at least, for these legal decisions to play themselves out. If that's the case, then, we've gotten away with this for 2 or 3 years for free. And that was sort of the argument that you hear now in retrospect about the Bush steel safeguard of, 2002, other types of import restricting measures. You get away with the protection for free. It's cost jobs, but politically it may be. No, right? And so the main distinction, I think, here is you're going to have to then reopen up this once-in-a-generation tax reform that we undertake 2 or 3 years from now. You don't want to have to do that. There's going to be no way to pay off a single country that might file a trade dispute against you, right? You're going to have to end up reforming the whole thing. In some of these other types of cases, you can recalibrate the exercise to be able to compensate an affected trading partner. Here, you can't do that. You can't say, well, China, if you bring a dispute against us, we'll compensate you by not having the border adjustment apply to you. Why? Because every other country would then say, well, that's an MFN violation, right? Now you're giving preference and you're discriminating across countries. The only fix will be to reopen the whole package and have to do it over again from scratch. Okay? So my concluding remark is, if you're going to do this kind of tax reform, you want to make sure that it's durable. You want to think about the international implications of this. You want to think about the discriminatory implications of this and try to think through what the WTO implications are, and then be ready, as I think Gary has suggested also, to maybe open this up for the possibility of having to deal with and address new rules within the system. But that's the kind of cooperation and approach to international engagement that we haven't observed recently, and that I think we need to be heading toward, I think, is a more fruitful process. Thank you.
Thank you, Chad. Thank you, Sherman. Thank you, Joe. Thank you, Caroline. If you could please come up on stage. I will start taking questions as soon as they're seated. I'm not going to try to shepherd this. I just want to say how proud I am of my colleagues. This has been an incredibly rich discussion. It shows the depth of expertise and commitment of these people and our colleagues earlier, that they got to this so quickly in the last few weeks. And to each of them, they talked through technical things, I think, very comprehensively and clearly, and I'm grateful for that. So let's start right there with our visiting friend. Then the next gentleman at the back mic, and then Mark, you can go.
I will assume, which I think that's okay, that
This is Jose de Gregorio,
Thank you.
who's a non-resident fellow here at the Institute.
I will assume that the proposal of the cash flow with the adjustment for wages and with the border adjustment is equivalent to VAT. And this is, I think, that what Joe did, trying to look at the effect on the exchange rate. I think that before going to regression, we have some case studies. So we can look what happened in Japan just in 2014. There were some strong effects on activity, but this was because there was a fiscal tightening. But there was also an increase in inflation to above 3%. So I imagine, and this was for a 3 percentage point increase in the VAT. So if I imagine that if the change is to an equivalent of a 20% VAT tax, a 10% increase in the price level in the US is not a minor number, I would say. It's quite huge. And this also, I think, that is related to the figures on New Zealand, because New Zealand, as I saw the slides, New Zealand had an inflation rate exceptionally high, about 10% during the VAT increase. And this may be, when you have high inflation, to introduce VAT is not very complicated in terms of price level. But for a country that has a 2% inflation target, having a 10% increase in the price level, a 10% decline in real wages is quite high. And this leads me to my second point, which is related to your regressions. What's happened in these cases, if the case of Japan and in the case of New Zealand, is that the domestic price level went up, you will have a real appreciation. But this real appreciation does not mean that it's a completely neutral, because it's not the same as an increase in the nominal exchange rate, the change in the price level. Because in this case, you are making all imported goods and also the locally produced imported goods go up at the same rate. This is not making less competitive our economy. That would be a real appreciation.
Thank you, Jose. I'll ask Joe and Caroline, who worked on this as well, if they want to comment.
No, I think I agree with what you're saying, Jose. I think Japan is probably the clearest case, because they raised the consumption tax 3 percentage points 3 years ago, and the consumer price index rose about 2 percentage points right away. And the difference between the 2 and the 3 mostly probably reflects that the consumption tax doesn't hit everything. So there are some things that don't get hit. And so it's the clearest case. And I think for small changes in value-added taxes, our sense from the data is that that's the typical thing, is it probably is just going through the price system, and that's why the real exchange rate moves. But for bigger changes and more generally, there is some evidence that it does affect the exchange rate. And at a minimum, our regressions support the idea that the real exchange rates are stationary in the long run, which means that they don't drift, any shocks to them tend to come back, except these shocks. So in other words, these are the one shocks to the real exchange rate that do not mean revert over time.
Yeah, I would just say that I went through a lot of the case studies, and that's very much what the evidence suggests, that the prices adjust. So even in the case of New Zealand, exactly as you said, if you look at the quarterly inflation rates, it was a huge jump from 11% to 19% and exactly mirrored the increase in goods and services taxes to consumption. And this was the case in several other countries where VAT rates increased. So I do think we expect to see it come through the price. It's a one-time effect. It can be stimulative if you don't have the wages go up immediately, but it is the Fed going to do it? I don't know. And so I think, again, this just points to the reason why we expect that the adjustment period would be messy with this kind of a policy.
Maybe something we should look at as well in future. I mean, you guys are continuing to develop this research, as Joe pointed out, and we will be publishing it, is maybe not in the same thing, but look at other examples of very large price shocks, one-time price shocks, and see what the effect's been. Obviously, this is only a subcategory. But anyway, you guys are doing great stuff. Next at the microphone.
Will Martin from IFPRI. Sherman mentioned there's no historical experience, but in Europe there's a lot of discussion of the social VAT, where you raise the VAT rate and lower the social security contributions, which is a bit like what's being proposed here, a rise in consumption prices and a reduction in labour costs, except this is a much bigger shock, bigger change rather than that. But I just wonder whether you could learn something from that. And it seems, the analysis there is that this leads to an internal devaluation, which is the sort of results that Sherman was getting. But in the longer term, Caroline, you're lowering wage costs and that stimulates output in the short term. But when you're near full employment, it's more likely to seems more likely to push up wages and to wash out as an impact on the cost to employers of labour. That's a question.
Okay, so there was a question mark there.
Well, I guess there's this question of how close we are to full employment given the labor force participation. So we'll see, but that's ultimately shouldn't be the purpose of this policy. So I'm not sure that's the debate we should be having.
I was about to make exactly the same point. In the simulation I described, we kept employment fixed. There is an argument for stimulating effective and export. It's a different story.
So I would like to second.
Marcus Nolan, Director of Studies at the Peterson Institute.
Thank you. I would like to second Adam's plug for my colleagues. I think it's been a very interesting program, and I look forward to the rest of it. But right now, I'm Coach Bill Belichick of the New England Patriots, and I'm preparing to, I knew Adam would like that, I am preparing to play the Atlanta Falcons in the Super Bowl on Sunday. And I know that Atlanta has a high-powered offense. We may be having to play from behind. So I go to my coaching staff and I ask them, what's the likelihood of a successful onside kick in the last 2 minutes of the game? Coaching staff comes back to me and they say, we've collected all the data for the last 15 years of high school football games in the Boston area. And we can tell you that the likelihood of an onside kick in the last 2 minutes of the game is 12%. And I think to myself, that's an interesting result. I'm not sure how much that helps me prepare for Atlanta. In the last session, Doug Holtz-Eakin said something in passing that I don't think should be lost, because it goes to a theme that Adam emphasized in his remarks about the Lucas critique and the fact there's two teams on the field. When someone asked Doug about managed exchange rates and pegs, he said, of course they would immediately adjust. So my question to Joe and Caroline is this. You've collected this historical data on a lot of, not to be pejorative, but little countries like New Zealand. We're contemplating a big change in the central country in the system. Presumably, the other guys are going to adjust to this prospective change in a way they didn't adjust to the changes in New Zealand. So my first question is, Do you think that that kind of Lucas critique argument affects how you think about the applicability or relevance of the evidence that you've presented to the case that we're considering? Secondly, if the answer is yes, and you think that the behavior of the other team is going to affect exchange rate adjustment, do you think that increases the likelihood of us landing in one of these kind of partial offset adjustment scenarios that Sherman modeled, which have really big effects that get very messy in Sherman's words? Or do you think that in the end you're going to get full real exchange rate appreciation no matter what, and that the fact that the other guys are gumming up the nominal exchange rate channel means that more of that appreciation will come through the domestic price level? That is to say, we'll feel it in inflation.
Thank you very much, especially for the Patriots reference, Mark.
Well, one thing that I didn't say, and I've been thinking about a lot, is that it clearly matters what the Federal Reserve is told to do. That is hugely important. We haven't discussed that.
I don't want you to be misinterpreted. Did you say what the Federal Reserve is told to do?
I didn't hear that. I was about to ask.
As I recall, you worked for an independent Fed. I just want to double check this.
Well, okay, so assuming that this would have to be passed by Congress, and since Congress sets the Federal Reserve's objectives, Congress might, as part of this law, explain to the Federal Reserve how it should interpret its objective in the light of this law. In other words, should you let prices rise just this one time because of this one change or not? And I think the Federal Reserve would have to listen to what Congress would say on that. That doesn't mean it's not independent. It just means that Congress has the right to tell the Federal Reserve what its objective is. And I think that's critically important, and we haven't talked about that. But Mark, for your broader question, I think the bigger things really are, there's so many moving pieces, and we're only looking at one of many big moving pieces that would have big effects and that we haven't analyzed. You raised the point, suppose this was just a plain vanilla VAT that everyone else has done, but the US is big. In that world, which is not what we're talking about, but in that world, how different would the results be? And that's a very good question. I tend to think we would see similar outcomes because we're moving towards what other countries are doing, and they would have no reason to object. I mean, Germany has a 20% average consumption tax rate. We have a 3% average consumption tax. If we raise our average consumption tax to 20%, how could Germany possibly complain, as long as we did it the same way they did it? So I tend to think that it wouldn't be that big of an issue, but I think the real issue is this is much more than that. This is far more complicated than that, and we don't know what the Federal Reserve would do.
I just want to add that it's not, we have a few case studies and data over this period, so it's some evidence. So evidence-based reasoning is better than no evidence, so that's one thing. But it's not just having the evidence from these cases, it's also theory. In this particular case, theory actually was borne out by the data. And so I do believe it's going to adjust. My question is, does it take 6 months? Does it take 1 year? Does it take 2 years? Does it take 3 years? Not whether it happens. I think the forces are there. Theory suggests it's there. The evidence supports it. The real question is, what can we do about that transition period, and is it worth going through that?
I mean, sorry, this is not me advocating my point of view. I want to draw you both out on this a bit further. If what you're saying is broadly correct, then it would seem that many of the things that the Trump administration has said so far on trade are profoundly wrong, because exchange rate manipulation by the Chinese or by the or what Peter Navarro has claimed is exchange rate manipulation of Germany by virtue of being in the euro area ultimately must be neutral. All these other things wash out. So, but if that's not what you're saying, then why did you both duck Mark's question about the possible exchange rate responses of other countries and assume that it must wash out. One or the other's got to be true. You either think that no matter what, these exchange rate things don't matter, the exchange rate manipulations don't matter, which I know Joe doesn't believe, or if you do, then why can't other countries pursue that as a form of adjustment or retaliation? It may not be nice, we may not like it. So that, I just want you to explain a bit more.
Sure. No, I think that's a fair question. I think it ultimately comes down to what is the purpose when countries manipulate their currencies or they do policies that affect their trade balance. Are they focused on the exchange rate and that's what they care about, or are they focused on their trade balance? Is that what they care about? And it turns out that that matters because, well, which it is. In other words, is it the exchange rate they care about or is it their trade balance they care about? Because the answer to that question determines, I think, the answer to your question. I think you implicitly are having a view that, well, they're not going to like the exchange rate effects of this and they're going to try to resist them. And I think if they care about the exchange rate per se, that's right. But if what they care about is their trade balance, and this is just a move that neutralizes the trade balance effect, then they shouldn't resist. And I think that's the key. What do they care about, their trade balances or their exchange rates? I was explicitly assuming they care about their trade balances and would allow an offsetting effect, but you may be right.
I just want to add to that I think the Chinese case is different because it's not and hasn't been a freely floating exchange rate, and they have capital controls in place, so it's not the same as the type of adjustment you'd have in the U.S., besides the fact that if there are these temporary effects and you control all these variables, you can keep it in place. So we would have a short-run period of a fiscal devaluation, which eventually would adjust because we're not going to keep intervening. Whereas in their case, one could argue as reserves rise that there's a continued policy. So if we were to do this and then have a continued policy to somehow keep it and control capital, it would be a bit different.
Thank you very much. We have time for one more question. Anne, if you could move to the thing. To the thing being the microphone. Thank you for understanding that.
Thank you.
Anne Kruger,
Kruger-Sykes.
legend in the profession.
Anyway, thank you. First off, I think it has been an excellent session. Let me just join those, and it's obviously an important question. In this whole discussion, with which I don't have any great quarrel one way or the other, but what Doug said was we want to reform corporate taxes. We want to reform corporate taxes because we have problems with inversion. We have problems with people keeping money overseas and maybe even investing overseas when they wouldn't otherwise do so because they've got that money there. And so in that sense, it's cheaper cost of capital to them than bringing it back, given the tax law. Now, if in fact that's true, and I suspect it's certainly partly true, then there's an effect that we're ignoring in all this, which is that presumably there'd be capital reflows, at least to some extent, to the U.S., or more investment in the U.S., or at least a shifting of some things that might have gone overseas that wouldn't. And that has to be, it seems to me, and this is a question really, isn't that an effect that should be taken into account? Because it would be one thing to be shifting to the border tax adjustment, however, or value-added tax, in the absence of any motivation of removing a distortion. But in this case, I thought the motivation was quite clearly moving a distortion, in which case to try and analyze it as if that wasn't the case bothers me to some extent. And I should just add that New Zealand was very different because New Zealand was coming off a time when their exports to the UK in particular had been shut down because of UK joining the Commonwealth, and it was part of a major reform that took into account many other parts of the economy. And therefore, in that sense, there was so much other going on that in one sense it's a better case, but in another case, if our other adjustments, namely the allocation of capital between here and abroad, both financial and real, is different, then it's a different case. So I just would like a little bit of comment on why are we ignoring what might happen on capital account, which would surely affect capital flows and therefore the exchange rate and maybe everything else.
Thank you very much, Ann. Let me go down the line, ask Chad and Sherman first, and then if Joe or Caroline want to add anything. But have we been ignoring this aspect? How big an effect is it? How should we take that into account?
I think it's a great question. I think we'll have to think about it a little bit as to how it would fit into these models and how it, we would think therefore that it would change the conclusions at which we're arriving. So Anne, I take your point. I think it's important, but I guess we need to more precisely model and put numbers on the size of the distortions that we're trying to correct in the first place to be able to put those in context.
Amen to that. And the tax has been proposed as basically sales tax based, a revenue tax rather than a tax on capital income. But in the end, it's got to come out of capital income. You've already paid out all the value added and intermediate inputs. So the question you need to ask then is, okay, when all is said and done, what does it do to relative profit rates of firms contemplating investment in various, either this country or the other countries, or whether they should close down or expand? And I haven't seen a lot of analysis of that. But the appropriate indicator then is on a capital income base, not a sales base for that calculation.
I hate to admit there's so many pieces that we haven't analyzed. It's just, but one more is the one that Anne raised, which is that if exchange rates move as part of this, it would, given the massive increase in gross cross-border positions we now have in the world that wasn't even true so much 20 years ago, it would have enormous wealth effects. U.S. holdings of foreign assets would fall in value, foreign holdings of U.S. assets would rise in value in a way that would be much more meaningful than would have been 20, 30 years ago. So, and I don't know anyone who's really looking at that yet, and I have to admit I haven't.
I guess our role has really been to look at whether the border adjustment is about competitiveness or not, so we kind of stuck in this really narrow lane that maybe is a bit too narrow. I would say that I think that falls on people like Doug Holtz-Eakin or maybe Gary, who really believe in destination-based taxes as being super important for real activity. I think they need to show how important it is. Because ultimately, and it gets back to exactly what Adam was pointing out, how important this is for real activity. That was one of the first questions Adam asked when he heard about this, and I think it's the right question. How much are we losing from all these guys that are keeping their profits abroad in real activity? That's ultimately what we care about. And I think to the people who want to do this, they need to show that it's really substantial. Then it merits going through this messy adjustment. But unfortunately, I don't think we've seen numbers that support how much real activity is actually lost.
Thank you very much, Carolyn. Thank you, all of you. It's wonderful to see this crowd continuing to consume facts, analysis, honest dispute and discussion, all the things that we hope will continue in Washington, and we know the Peterson Institute will continue to try to do. Please join me in thanking my colleagues for their superb work. I know that the people present in the room are not going away because the free lunch is about to appear. After lunch, however, we have the special treat of Jason Furman's debut appearance, and he will sort of take us back to some of the more cosmic overall approaches to the tax code, having, I think, enjoyed learning from his new colleagues here at Peterson as well. For those of you online, we will reconvene at roughly 12:35 and look forward to seeing you then. Thank you.